in pure Valhalla chaos mode with 18 plus sarcasm and real-world roast energy. Next, Section 2 disclaimer. Listen up, Lodu and Legends. Before we jump into Rise of Coins and Banking, where kings flexed on coins and banks started their scam career, here's your official survival manual. 1. Not financial advice. If you think this lecture is a magic key to overnight Lambos, slap yourself. This is education, not your shortcut to running away from EMI collectors. Number 2, the roast clause. I will roast retail, bankers, influencers, Kartikeya, Sudhanshu, and sometimes you. If you cry, go buy mutual funds and read Rich Dad, Poor Dad again. 3, chaos clause. History here isn't a bedtime story. It's betrayal, scams, greed, blood, and stupidity. If you can't handle brutal truth mixed with savage humor, close this PDF, open Instagram, and go copy-paste entrepreneur in your bio. 4, adult warning. We are 18 plus uncensored here. If words like Chutia, Karma Bitch, or Valhalla Justice offend you, then bro, how are you even planning to survive the market where your portfolio will scream way louder? 5, modern roast insert. Americans built tech that fucked the world. Internet, microchips, rockets. Stress from that? They earned their hookup culture. But in modern India, stress from what? Standing in line for iPhone EMIs? Roaming the streets calling yourself founder? When the only thing you founded was a reason to fuck each other without code, capital, or cash flow. Sit down. 6, the retail poverty clause. No matter how many coins, banks, or apps arrive, retail chutia remains poor if they don't learn discipline, logic, and liquidity. That's the eternal truth. So buckle up, Lodu and Legends. We're about to see how shiny coins turned into paper promises, and why retail still claps for scams like it's Navratri DJ night. Want me? Rise of Coins and Banking, aka Kings Invented Scams, Retail Invented Poverty. Now, Section 2 Introduction. Rise of Coins and Banking. So picture this. Once upon a time, humans got tired of carrying goats, rice sacks, and random shiny shells to trade. Because imagine Kartikeya walking into a bartering market like, bro, 1 chicken for your daughter's necklace. And the seller goes, fuck you, my daughter isn't worth poultry. So boom coins were born. First, it was lumps of shiny metals stamped with kings' faces. Basically, kings were like, look, peasants, my face is now money. Every time you buy bread, you basically kiss me. Flex level equals emperor of scams. And then came banks, those holy temples of trust. Spoiler, the only thing they managed well was scamming retail since day one. Banks said, give us your gold, we'll keep it safe. Retail said, wow, thanks, Daddy Bank. And the banks went behind the scenes and loaned that same gold to 10 other idiots at interest. That's like Sudhanshu borrowing your bike, renting it out to Uber, and then charging you to use your own bike back. But here's the catch. Coins and banks changed the game. Suddenly, trade exploded, cities grew, and kings started flexing their wealth beyond borders. This was the beginning of the financial system as we know it, but also the beginning of the retail poverty cycle. Because even back then, retailers were poor AF. Why? They saved in coins, kings debased the coins with cheaper metals. They trusted banks, banks collapsed during wars. They thought future secure, kings raised taxes like hungry bastards. Basically, retail was getting slapped harder than Kartikeya trying to explain EV is the future. And Legends, remember this. Coins and banks weren't just about money. They were about control. Whoever controlled coins controlled trade, and whoever controlled banks controlled kings. Even kings bowed down to moneylenders sometimes. That's how powerful early banking families were. Section 2 Deep Dive, Rise of Coins and Banking. Full Valhalla chaos, brutal clarity, stupid-proof English, big roasts, and real lessons you can actually use. This one's long. Drink chai, sit tight, and read like your money depends on it, because it does. Section 2 Deep Dive. Topic, Rise of Coins and Banking. How shiny metal, paper promises, banks, credit machine, and why retail still gets wrecked. 1. The big arc in one line. Barter sucked, people picked things everyone wanted. Metal coins standardized value. Kings minted coins and learned to cheat. Receipts and banks turned metal into credit. Fractional banking multiplied money. Elites got richer. Retail mostly remained poor. Now, shocker 2. Why coins even happened? Simple. Barter equals, I want what you have. Too awkward. People picked common stuff, salt, cattle, shells, that others accepted everywhere. Metal, silver, gold. One because it's durable, divisible, and shiny. Easy to carry and store value. Stamping a king's face on metal made people trust the coin. Authority equals trust equals money. Real talk, coins weren't mystical. They were a social agreement backed by a ruler's authority. If the ruler said it's money, people used it. That power is where the trouble starts. Number 3, kings, seigniorage, and debasement. The OG stealth tax. Seigniorage equals profit from minting, face value minus metal cost. Rulers loved this. When war or spending hit, rulers didn't raise taxes politely. They mixed cheaper metal into coins or minted more. That's debasement. People didn't notice at first. Over time, prices rose. Result, your saved coins bought less. Lesson, debasement equals early inflation. Same game as printing money today, just with worse metallurgy. Roast, kings invented policy centuries before Twitter trolls invented market advice. Nana 4, receipts, banks, credit, how the magic's trap worked. Merchants stored gold with trusted keepers and used receipts for trade, easier than lugging metal. Receipts circulated like money. The keeper became a bank. Banks saw that not everyone withdraws at once, lend part of deposits, fractional reserve banking. One deposit, many loans, money supply expands. Great for growth. Dangerous for trust. Simple example, deposit 100 coins, bank keeps 10, lends 90, those 90 become deposits elsewhere. Banks lend more, money multiplies. Risk, if everyone demands coins at once, bank can't deliver. Bank run. Number 5, the plumbing gets complex. Bills, letters, and central banks. Medieval merchants invented bills of exchange and letters of credit to trade internationally. This built trust networks. Governments started borrowing via bonds. Banks underwrote and intermediated. Repeated crises led to creation of central banks, lender of last resort, to stop runs. But central banks also made modern money manipulation possible, QE and printing. Truth, every layer that made trade easier also added fragility and hidden risk. Complexity equals opacity equals surprise. Number 6, fractional reserve, leverage bubbles. Credit easy, people leveraged, asset prices rose, land tulips, stocks. When credit tightens, the unwind is violent. Forced selling, price collapse. Retail often buys late, FOMO, and sells at panic. That pattern repeats. Tulips, South Sea, 1929-2008 meme stocks. Roast, Kardake waits for confirmation on Reddit, then buys at top. Congratulations, you played yourself. And number 7, why retail stayed poor, the structural reasons. Access and timing. Elites get first deals, cheap credit, private info. Retail sees headlines later. Fees and taxes. Small savers pay higher relative fees and get worse rates. Behavior. Retail chases narratives, not balance sheets. FOMO plus no risk rules disaster. Regulation and power. Institutions lobby rules that favor scale. Retail is price taker, not game maker. Simple truth, the plumbing was built to let large actors scale and profit. Retail provided liquidity, willingly. 908, modern parallels. Same game, better UI, debasement, modern money printing, QE, inflation. Fractional reserve, shadow banking, repo, money market funds. Bills of exchange growth, derivatives and swaps. Complexity moved risk off balance sheets into opaque channels. Bank runs now happen via digital runs, withdrawal freezes, social panic. One tweet can start a stampede. Godsey cameo, liquidity. Godsey still rules. If market makers / LPs pull quotes, assets gap and retail gets wrecked. India, modern culture. Roast, short, sharp. America built tech, chips, rockets, platforms, then had hookup culture as a byproduct of wealth creation. They earned it. Modern India copied the hookup creator aesthetics before building the tech backbone. Result, loudness, reels flex, but little durable value. Financially, people ape markets and products without learning fundamentals. Instagram founders equal selfies. Real builders equals code, factories, patents. Roast behavior, posting entrepreneur while running on parental credit equals clout, not creation. Don't confuse viral hits with structural wealth. Number 10, real-world examples, fast receipts. Debasement, inflation. Ancient rulers debased coins. Modern central banks expand money supply, both reduce purchasing power. Bank runs, from ancient coin hoards to modern digital bank panics. Credit bubbles, easy credit fueled housing tech bubbles. When funds dry, pop is violent. Retail traps today, leveraged token products, margin trading on hype, fake guaranteed, yield fintechs. Number 11, practical survival rules. Straight, no bullshit. 1. Understand where money comes from. Credit, central bank actions matter more than hype. 2. Respect liquidity, Godzi. Check volume, bid-ask spreads, and depth before sizing trades. 3. Position size rules, risk 0.5 to 1% of capital for risky trades. Don't be the guy who bets the rent. 4. Avoid blind leverage. No funding rates, margin rules, and worst-case exit scenarios. 5. Prefer cash-flowing assets or diversified ETFs to single-topic speculation. 6. Watch credit spreads and repo rates for stress signals before headlines do. 7. Keep some dry powder for true dislocations. Don't be fully invested in froth. 8. Learn basic bank balance sheet intel, loan to deposit, NPLs, liquidity coverage.
Pikachu!
Number 12. Tactical checklist. Do these weekly. Central bank statements and rate moves. Short-term funding market data, repo funding rates, CPI and commodity moves, food, oil, base metals, volume and ADV on any thin names you hold. New retail high-yield products. Read the fine print. Number 13. Roasts and class lines. Say them loudly. Kartikai Chutia bought the top and calls it conviction. He's holding the poster, not the company. Sudhanshu Chutia thinks Miss Y loves him. She doesn't. She uses his liquidity and ghosts him at the open. Goldie Bai studies policy while others rant about clout. Guess who gets to shape markets? You posting founder pics while your payroll is on dad's card. Congratulations, you created content. You didn't create value. Schnur 14. Short exercises, 5 to 15 minutes each. 1. Timeline. Write 8 bullets from barter, coins, banks, central banks, digital money. 2. Check one local bank's balance sheet. Find loan to deposit and NPL ratio. If moderate, be cautious. 3. Scan liquidity. Pick a small stock you like and check ADV and bid-ask spread. Imagine selling 5 times your typical size, would you? If not, size smaller. And our 15. Valhalla mic drop. Tattoo it. Open quote. Coins were the king's flex. Banks turned that flex into credit and leverage. Retail applauded. If you don't learn the plumbing, you'll always be the liquidity that someone else drinks. Close quote.